Hi, everyone. Welcome to today's webinar with me, Fawad Razaqzada, market analyst with Think Markets. In this webinar, I will be presenting the live analysis of major FX pairs, indices, commodities, and please feel free to ask me questions during this webinar or at the end of it on any market that you are interested in. This is meant to be a very it's meant to be a very interactive webinar, so please feel free to ask me questions. Now, I'm going to share my live charts with you in a minute or so, but before I do that, please read the risk warning, which should be on the screen right now. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. All right, so just to remind you guys about this webinar, we have this webinar happening every Tuesday at 11:30 London time. And it's mainly technical analysis of major currency pairs, gold and indices, but we do cover or touch on fundamental analysis as well. There will be a Q&A session at the end. So if you're watching this on YouTube, please make sure to tune in next time, because you will have the opportunity to ask us questions about any markets that you are trading or you might be trading. Perhaps it's something that you're not sure about and want a second opinion, and we'd be more than happy to provide that analysis for you live as we speak. But anyway, what's driving the markets? So obviously it's been vaccine optimism. It has been for the last several months, hasn't it? The stock indices in the US continue to head record highs, and in Europe as well, we've seen multi-year highs for the likes of German DAX index, French CAC, and Spanish IBEX. The FTSE had been underperforming because of the strong pound in recent times, but over the last couple of days, the FTSE has stormed back to life, with miners, banks, energy companies all leading the charge higher as underlying commodity prices continue to push higher on hopes that demand is going to recover in 2021 with the developments of vaccines. So that, as well as the ongoing Brexit, well, it's not ongoing. It's Brexit, a no-deal Brexit has been avoided, which is great news for the pound, and potentially good news also for some UK-listed companies. But because the pound has been rising rapidly over the last several weeks, this has prevented the FTSE from being from joining the global rally. But as I said, that has now changed. We have seen the FTSE storm back to life, and we could see further gains for the UK 100 index in the days ahead. In terms of data, it's going to be a low-key week, I would say. There are a couple of things to keep an eye on, which I discussed in the week ahead report. By the way, we write a week ahead report every Friday, and in this one, you will see things to kind of keep an eye on in the week ahead. And so today we had, Eurozone data, Eurozone GDP came in stronger. German ZEW survey was also stronger than expected. They caused the euro to bounce nicely today. And we had earnings from Glencore, which saw its shares rise. Wednesday, we'll see the release of CPI data from UK and Canada. We have used American retail sales, as well as the FOMC minutes, among other things. And there's going to be lots of earnings on Wednesday and Thursday from Europe. So London-listed Rio Tinto is going to report on Wednesday, for example. And then on Thursday, we have Airbus, EDF, Barclays, and a few others to look out for. And earnings will continue from Europe on Friday. We'll have lots of banks reporting then as well, as you can see over here. And in terms of macro data, well, today, as I mentioned, the bulk of European data has already been released. We have a couple of not so significant US macro pointers coming up. Tomorrow on Wednesday, We have US retail sales and FOMC minutes, as I mentioned. On Thursday, it's a busier day. We have Australian employment report, the ECB policy meeting minutes, US unemployment claims, and a few other not so significant data releases to look forward to as well. On Friday, retail sales from Australia, UK, and Canada. And we have consumer confidence from the UK. But the key data release is likely to be this, the latest flash services and manufacturing PMIs from places like Germany, Eurozone, and the UK. That's going to be very important, as it does provide us with leading indications in terms of how these economies are performing in this first quarter of 2021. Now, let's go straight to the charts and start with the FX market. So the ongoing trend has been dollar weakness because of lack of haven flows into the greenback. Investors have been buying more risk-sensitive currencies like the euro, the Aussie, the Kiwi, and other commodity dollars, as well as emerging market currencies like the Turkish lira in the last few weeks, months even, because of ongoing expectations that the global economy is going to recover and recover sharply, because there's so much stimulus from central banks and governments supporting or likely to support the recovery. So the market is currently expecting an accelerated pace of recovery once lockdowns end, and hopefully lockdowns will end soon, especially in the UK. The UK is kind of leading the vaccines race. Some 15 million people have already been vaccinated in here. And the government is on target to achieve its vaccine targets on 22nd of February, I think. The government will outline its plan in terms of when lockdowns are likely to end, under what circumstances, etc. So hopefully, at least for the UK, we are heading to slightly more normal times ahead in the weeks and months ahead, provided that we don't see a new variant of the COVID that's more deadly or contagious. But if everything goes to plan, lockdowns will soon end, hopefully, and this should keep risk appetite high for UK-linked assets. So the pound could extend its gains, so too could the FTSE, for example. And those are the kind of markets we want to focus on. But I'll start off by looking at the dollar index here. And as I mentioned, that the trend has been bearish on the dollar. You can see that the brief breakout above the bearish trend line on the daily chart failed to lead to anything significant. And the index hit resistance at 91.50-ish to 91.75 area, from where it's turned lower. It's gone back now below the broken trend line. So the trend line has been reclaimed by the sellers, which is bearish, right? So from here, as things stand, it looks like the dollar is going to head to a new 2021 low. So the low was hit in January, early January at 89.20. It looks like that's the area it's going to go down to next. Below that, we have the 2018 low at 88.25, and that would be my next target, because there's going to be lots of trap traders who try to buy the bottom in the dollar index will have placed their stops below that low. Not necessarily just by going long on the dollar index, but they may have shorted the euro dollar, for example. So if you look at the euro dollar, we're seeing a similar pattern, right? So here, this blue line was the key trend line, if you like. We fell, prices fell below that trend line. It looked bearish at one point as the key 120 handle was taken out momentarily. But by the very next day, on 5th of Feb, price reclaimed this level and went back above the broken trend line, thus causing another trap for the sellers or for the bears. So the bearish scenario didn't play out because we didn't hold below 120. And this is what I was expecting to see, further continuation higher. You can listen to my previous webinars on this matter on our YouTube channel. And so far, the euro dollar is heading towards the projected target. And initially, my short-term or the short-term trouble area was around the shaded region here. Price is testing that region, but the way it's consolidated below that area, we've had a number of days where price didn't really move much ahead of this potential resistance zone, and today it's trying to break through it. So watch out if we can go on to take out this area of resistance. If we can do that, then from there's not a lot of further significant resistance until possibly the previous high at 123.50. So we might poke above that level in a very short order as the sellers potentially rush to exit their trades. So what happens thereafter? If it depends really on what price does around 123.50. Should it get there? If, for example, we go above that level and price then quickly rejects it and it goes down, then that would indicate a possible double top or a false break reversal scenario, in which case price could then head down to the most recent old resistance, which could be at any level between where we are and 123. But let's assume that price rallies really sharply tomorrow or today, and it takes out that level, and then it gets quickly rejected. If it does get rejected, then the nearest support or old area of resistance would be the shaded region, right? So that's where you would expect the price to then go down to next. But that's not the base case scenario for me. What I think might happen is price is going to start pushing higher and take out the high and consolidate there for a few days before extending its gains towards 125 and higher. Because if you look at the weekly chart or the monthly chart even, it looks like price is following the script from 2017 and early parts of 2018, when it rallied sharply, consolidated for a while, and then it continued higher to 12500. We're seeing a similar pattern unfold here. Price is rallied, consolidated, and now it's trying to, it's kind of bounced off that key support at 120. So it looks like it's going to extend its gains towards the 2018 high, just above the 125 handle. Also note that the long-term bearish trend has been taken out, which is a significant bullish development in the long term. So the euro dollar could be heading higher from here. And it could be heading higher like how the pound has behaved in recent times. If you look at the cable monthly chart, it's been a one-way trade for the last several months. Looking at the daily, price continues to trend higher inside this bullish channel, continuing to follow the projected path that we had drawn previously. The 140 psychological level is the next key upside target, because 140 is where the cable was trading around before the 2016 referendum. If you look at the historical chart, like this monthly chart here, this is where it was trading around. So 140 is important. Don't take it lightly. I think it will get there because we're very close to it. But potentially, with the UK now avoiding a no deal exit, etc., we could see the pound go up to 150 or even higher in the coming months. So I'm quite bullish on the pound, and that rally towards 150 could be underway already. But my short-term objective is that 140 handle. Let's see what happens when it gets there. So in terms of support, look at 139.19 on the daily chart, 139.20. This is the previous day's high. If that level breaks, then the next level down is this area here at 138.60-ish, which was the point of origin of the latest kind of breakout from this small consolidation. Then below that, there's nothing significant until 137.50. So those are the key potential support levels to watch in the event we get a pullback. which could happen, obviously. But any short-term pullback should be seen as that, a pullback, rather than a trend reversal, until and unless price breaks through an old low like this one. This was the most significant low at 135.67. So until and unless price breaks through that, the path of least resistance remains to the upside. So any short-term retracements you see in the interim should be taken with a pinch of salt. Give me 1 second, guys. Yeah, so that's the pound for you. We are looking at a very similar picture in all other major currency pairs. The Aussie here, for example, is coming up to retest the old highs. And the Aussie has held this bullish trend line. So unless that trend line breaks, the path of least resistance remains to the upside for the Aussie. Likewise for the Kiwi, nice consolidation. Actually, the Kiwi is looking really nice here, doesn't it? Look how many days it's kind of spin in consolidation here, and now it's trying to break out again. Very bullish in my view. So if this breakout can hold, then we could see a sharp continuation higher in rates. So what I've just drawn here is like a triangle continuation pattern. In bullish trend, you see lots of these patterns. For example, we had one here. Look what happened once price broke above it. So the longer it spins in consolidation, the more it will likely go up once that consolidation is resolved. In this case, the consolidation was resolved to the upside, leading to a sharp rally. So yeah, that's the major currencies for you. The dollar yen is testing the 200-day moving average. The dollar yen hasn't followed the other dollar pairs because yen is a haven currency, and at times like now, when stocks are rising, commodities are rising, the yen tends to fall because it's more of a haven currency than the dollar. So that's why the dollar CAD has been, the dollar yen has been more. It's been looking more bullish than other dollar pairs. But it is testing the 200-day moving average. So this could be a potential top around here for the dollar yen, although I'm not too sure about that. This is the market I really want to avoid because I'm not very confident in terms of where rates are headed in the short term. And so I would rather look at a yen cross than the dollar yen because I am bearish on the dollar as a currency, but against the yen, I'm not so sure. So if you look at pound yen, euro yen, they're all pushing higher. Canadian dollar yen recently broken above this long-term resistance and it's gone up. So I would be more inclined to look for buying the dips in these yen crosses rather than trade the dollar yen. Does that make sense? Okay, enough about currencies. Let's move on to indices. And indices are looking bullish still. The DAX, German DAX, has been trading higher, holding for the most part above the 21-day exponential. Recently, it hit an all-time high here, and it's consolidating just below that now. So it looks like it wants to push further higher because of the way the index is behaving. It's not showing significant it's not showing significant weakness as it tests these old highs. we saw a 3-day sell-off here, and it was quickly reclaimed. Kind of price index recovered really quickly, and now it's testing that resistance area again. So I think it's going to break out and follow what the S&P is doing. S&P is, well, it's Monday was a bank holiday in the US. Today the index futures, or CFDs in this case, point to a gap higher in the cash open when Wall Street opens for trading. So there's nothing bearish about this. Yes, it may be overextended. We may see profit taking, but in terms of actual price action, it's really constructive. It looks like a rally to 4,000 could be on the cards, which is where we have the 161.8 Fibonacci extension of the most recent down move converging. Nasdaq, similar picture, printing new all-time highs. So it really is, a dip buying market, the stock indices, as things stand. Obviously, as the indices continue to push higher and higher, it increases the probability of us seeing a sharp correction. But so far, each correction have been shallow and bought. So don't be surprised if we see another correction of some sort, that the buyers step back in and push the markets back higher. One particular index I want to talk about is the FTSE. I have spoken a lot about the FTSE in recent days, and previously we were looking at this bull flag pattern. The index had been contained inside this for several days, as you can see here, until end of last week, until Friday, when it finally broke out, as you can see by this candle. On Monday, there was some further follow through to the upside, and today it's kind of consolidating those gains. So very little surprise to see the index consolidate like it's doing at the moment after a sharp 2-day rally. But given how long it had spent in consolidation, and given that other major global indices had been rallying prior to the FTSE breaking out, the length of consolidation alone would suggest to me that the FTSE has further upside to go. So I would be inclined to look for bullish setups on the FTSE than bearish. And one of the ways you could do that is see if price comes back down to this area of old resistance. I don't think it will come back down to that area, to be honest. It may do, but ideally what I would like to see is a period of consolidation around where it's trading at the moment, maybe a 1 or 2 day consolidation, and then look to trade long to take us above the old highs. In terms of commodities, gold and silver are looking mixed, I would say. Gold is still, this is the daily chart of gold, still holding below the 200-day, but above the long-term 1800 support. So it's kind of stuck in no man's land really here. Not a major surprise, to be honest, because on the one hand, you have risk on, and on the other hand, you have dollar weakness. So those are providing kind of conflicting signals for gold. And overall, it looks like the market is happy to sell gold as things stand, but it's kind of still above that long-term trend, long-term support at 1800. So I don't have too strong a view on gold at these levels. Ideally, I would like to see gold create a bullish signal because of the fact that other dollar pairs of weakening, like dollar, other major currency pairs are strengthening, like the euro dollar, the pound dollar, Aussie dollar, etc. So I think from that point of view, I'd like to see gold create a bull signal to look for long trades than short trades, but we're yet to see that. I think one potential bull signal or bullish signal would be if we reclaim the 200-day moving average If you go back above it, I think that would be bullish. Silver is looking a little bit more constructive than gold. It has recently broken this bearish trend line, consolidated here for a while in this key support area. If it can get above 2790-ish, the previous resistance level, if it can get above that level, I think it could be heading towards new highs for the year. Silver is more of a industrial metal than precious metal. So at times like now, when investors expect the global economy to recover, silver tends to perform better than gold and track copper prices. So if you look at copper, this is the daily chart of copper. Copper has been rallying rapidly. And silver and copper, they have strong positive correlation. So looking at this chart, that makes me kind of bullish on silver, more bullish silver than gold, certainly, as things stand. But I do need to see that bullish breakout on silver to become a bit more confident about looking for long setups. Guys, I have run out of time. Thank you so much for joining me. I can't see any questions. If you do have any questions, please don't hesitate to get in touch with me via Twitter. I'll be more than happy to answer any questions until we talk again at the same time next week. Take care. Bye-bye.